Very nice to see you all. What a great audience. One comment that we always get is how opaque EIF's organization actually is. What do we do? Who are we? So we thought today we'd lift the curtain a little bit and show you who we are, what our teams like, and what it is that we do every day that you guys keep us busy. So we'll present EIF, and then Sarah, Richard, and I, we are each working in the 3 investment teams of EIF. We'll explain to you what we do, and then of course, times for questions and any comments that you have. So diving into EIF, who are we? You heard it already. Believe in small also means that our DNA is supporting SMEs and mid-caps in Europe. This is really our bread and butter activity, why we were designed back in '94. So we are almost reaching adulthood, our 30th anniversary in a couple of years. Since '94, we've actually worked with 1,300 intermediaries and supported more than 1.8 million companies throughout Europe. We are a European institution, and our shareholders, as you can see, the EIB and the Commission are also our main partners in terms of mandates and money that we can actually deploy. So you heard a lot about InvestEU already, but as you can see here, it's the bulk of our investment activity jointly with EIB, but we also have a lot more mandates. We deploy about 177 mandates throughout Europe, throughout stages, and throughout products. So a lot of different activities. By the way, you can see here our activity is not only equity. So we are really separated in 2 major legs in EIF, one being guarantees and securitization, so working with banks throughout Europe to provide more financing to SMEs, to provide guarantees so banks lend more money to SMEs. And the other leg being the equity activity, which is where the 3 of us actually sit. And I will pass on the mic on to you, Sarah.
Thanks, Elodie. As mentioned, EIF's role has been historically to be the main risk finance provider for SMEs as part of the EIB group. However, with time and also changing market trends, EIF's objectives have been enlarged, not only to support SMEs, but to support the development of some specific themes and activities across Europe. It all started back a few years ago in 2019 when we introduced a specific policy scoring framework at the level of our mandates to measure the impact that the mandates had on the European private equity landscape. And this was then followed by integrating elements from, for instance, the Paris Agreement, but also the EU taxonomy into the objectives that we are pursuing. Eventually, we came up with a framework that is composed of 4 vertical pillars and 2 horizontal elements against which we assess the value added of the proposals, the funds, the teams that we potentially invest in. So you have one pillar focusing on competitiveness and growth. So this is reflecting, I would say, EIF's historical activity of supporting business growth, supporting internationalization of companies and territorial development. Then, of course, the second element is the fostering of innovation, where we try to have a specific objective of further developing elements like life sciences, disruptive technologies, and to ensure Europe remains competitive across the globe. The third element, social impact, skills and human capital, it's integrating elements that historically have been a bit more intangible. So with this pillar, we are covering impact strategies, but also activities around culture, creativity. And then finally, the fourth pillar is the sustainability and green transformation, where we try to find funds and teams that are specifically addressing topics around energy transition, climate solutions, and environmental products and services. And in addition, there are two other elements which are transversal objectives that we seek across every fund we invest in. One is the dedication and allocation towards climate action and environmental sustainability. So these are specific dedication towards activities and operations as defined in the EU taxonomy. And the second element is, of course, also the economic and social cohesion that these funds and teams are fostering.
Yes, so good morning, everyone. I'm one of the few male representatives and attendees of this conference, so I'm very privileged to be here. So just to pick on what the others already started to say, our presentation will be focused on how do we channel exactly funding to SMEs and mid-caps. Our teams focus on investing basically in closed-ended funds across basically three categories. First one is venture capital. The second one is lower mid-market private equity / hybrid debt equity. And the third element is private credit. What is EIF's role is basically to provide corner store investments. The average ticket size is around 20-30 million in these funds, with the objective to attract additional investors, be it institutional or individual private investors, and also basically validate these investment proposals and provide structuring input so that these funds then have terms and conditions which are more or less in line with prevailing best market practices. Why is it beneficial to the lower mid-market businesses that we support? It's because we can reach founders of disruptive technologies in the ICT, life sciences, and social impact space. Also, we can unlock the growth potential of lower mid-market companies, be it international or national growth, by providing capital. And this capital could be in the way of equity or debt, which can be bespoke and flexible compared to traditional bank financing. And just to give you some raw numbers on the stats, so our net commitments stood at around 37 billion as of June this year, and roughly 50% is represented by venture capital, 35% private equity, hybrid debt, and the rest 15% private credit.
And now maybe it's time to actually dive into your specific sectors. Actually, I don't know how to put it, but we're going to dive into venture capital, private equity, and private debt markets. Who wants to go first? Sarah, maybe?
Yes, thank you. So I'll start with EIF's lower mid-market activity. So what is the lower mid-market space? Basically, it's the small cap segment of the European private equity landscape. The lower mid-market team has been investing in the market for over 20 years. We have in total committed 16 billion to European fund managers, which represents an annual budget of around 1.8 billion. In terms of team, we are a team of 36 investment professionals, and currently we cover a portfolio that is composed of more than 500 funds, and this across more than 350 different GPs. We assess on average per year 200 to 120 new investment proposals across all geographies, across all sectors, and many different strategies also. Historically, so the lower mid-market focus was to provide finance via intermediaries, so funds to SMEs. So why SMEs? Because SMEs represent across Europe about 80 to 85% of the entire GDP contribution. They are the main employer, so securing jobs. So it's a very large space that you can tap into. In terms of fund sizes that we support, this translates also into a very wide range of investment fund sizes. So I would say broadly from 80 million up to 1.5 billion. And in terms of company sizes, so this represents enterprise values of up to 250 million. As mentioned, so our coverage is across the EU 27, and the sectors range from consumer goods over to industrials, ICT, healthcare. So it's very broad. In addition, I think the strategies that we cover range from the more classical growth buyout strategies over to pure growth and expansion players, hybrid debt equity providers, and also private debt funds. In terms of our teams, so we are composed in total of 36 investment professionals, taking into account also our dedicated secondary unit. And what better way to create a diverse portfolio than to have a diverse team in the first place. So from the 36 investment professionals, we are 18 women, and our team is composed in total of 13 different nationalities. In order to have a good access to the market and be able to further develop the regional coverage, we are set up by country coverage with two divisions, one focusing on Western Europe, the second one on Northern Europe, Eastern Europe, and Southern Europe. And in addition, we have 8 specific units to cover these markets as well. So with a specific focus on France, the DACH market, Benelux, and Pan-EU funds on the one hand, and then a coverage of the Nordics, Central and Eastern Europe, Iberia, and Southern and Eastern Europe, which includes Italy. So I have mentioned this wide geographical outreach that we have, and I also wanted to give you some explanations why we are set up by region and country focus. It's because in the lower mid-market space, the countries and the stage of development of the different PE markets in these countries are very different and currently face different trends and difficulties. If we start just, for instance, from the Nordics, the Nordics have always been very strong in developing companies, especially in the fintech space or developing consumer brands and healthcare space as well. Then the UK and Ireland, so we can unfortunately no longer invest into UK-focused funds, but there's still a significant presence of teams in the UK with a wide pan-European coverage that we cover. This is, of course, I would say one of the most developed markets in Europe, so valuations tend to be higher. In the Benelux, there is a very strong presence of family-owned businesses. So here, management teams rather seek to team up with the GPs. France, definitely one of the most developed private equity markets in Europe. Here, the competition in terms of teams that we can support is much higher. So, of course, we also have to apply a higher selectivity. Finally, the DACH market, which has always been slightly underdeveloped compared to other Western European private equity markets, with currently a lot of need for digitalization and succession solutions required at the level of companies. Finally, Italy, which is, well, a very large manufacturing economy with many many investable companies, still largely uncovered by institutional investors. So the entry valuations there are more interesting. It's definitely an interesting market to keep in the eye. Then Central Eastern Europe. A high proportion of companies that have the potential to expand regionally by applying a buy and build strategy. And finally, Iberia, a market with strong presence of SMEs, but widely underserved by capital providers. I've tried to show you on the screen, you see the number of teams and funds that we supported in 2021, so last year. And I think it's representative a bit of how our portfolio represents, on the one hand, the level of development of certain markets, for instance, 12 new transactions that were done in France last year. But at the same time, we have done the equal amount of transactions in Southern and Eastern Europe. So a market where there's definitely a higher need for us to intervene and further develop this region in terms of private equity financing. What are the elements so that we're looking for in strategies of funds that we invest in? And I think here we have to demystify a bit what the lower mid-market space, or maybe historically called it the buyout space, is doing. We put a very large emphasis on the actual value creation that is being achieved by the investment strategies. This value creation is in our portfolio mainly coming through two elements. One is EBITDA growth, so growth of the fundamentals, the operations of the company, or multiple expansion. We really consider here private equity teams to act as sparring partners to companies and help them in achieving this growth through various opportunities and activities, being, for instance, improving processes, introducing new management, introducing new functions with specific skills like marketing, sales, applying an active buy and build approach, so helping the companies to select attractive add-on investments, and helping the company to grow, for instance, by expanding the product portfolio, changing the product mix, or expanding internationally by creating a wider regional coverage. But as mentioned, so EIF has, of course, a number of policy objectives to follow, and we are a very strong supporter of first-time teams in the market. So we help to develop the market and help new teams to develop. If you look at our historical pipeline, you'll see that more than half of all the proposals that we have screened in our team, but it's also similar for the other teams that my colleagues will present, more than half of the deal flow has come from first-time teams and managers. And how do we help these teams? First of all, it's, I think, by just being present in their fundraising. So we have generally a strong catalytic effect, especially in those regions where institutional investors, private investors are more shy to intervene. There we can, depending on the mandates that we have, we can represent up to 49% of a fund. For some mandates, even 70%. So we really help the teams to kickstart and have the necessary financing to start the investment activity. A second pillar where we try to be helpful is by providing structuring inputs. So what does this mean? We, together with the team, we reflect on the strategy, on the optimal portfolio construction. We review with them their budget to see whether the budget is sustainable at all fund sizes, whether the team is sufficiently stuffed, whether additional resources, maybe with some specific skills or market expertise, are needed. So that's more, I would say, a dialogue that we try to have with the teams to help them reflecting about their strategy and the opportunity that they want to pursue. And then a third element where we try to have also an impact is the structuring inputs, the implementing best market practices. So this is especially taking place at the level of legal negotiations, where we have a set of standard requirements that we're expecting to see in terms of governance, LP protection, and we systematically try to negotiate and integrate these elements into the legal documentation that we sign with the managers. Just a few examples of all the first-time teams that we have supported over the past. And also just giving you a brief overview of some examples that are in our portfolio where you can see there is a good diversification both in terms of sector coverage, in terms of geographical coverage, and also types of managers that we support. Would here a few very developed private equity players, but also funds that are female-led funds, funds in Central Eastern Europe, first-time teams, developed teams, and so on. Just a very few words about the current market trends that we see. So there's at the moment a certain uncertainty in the market, both at the level of limited partners and also GPs, especially for institutional investors, given the current turmoil in the public markets. This has led to the alternative asset class being now overrepresented in their portfolios. So it's a so-called denominator effect, which has led to the result that there is currently, let's say, a much slower fundraising and availability of financing from institutional investors to alternatives. At the same time, there's more interest from family offices and smaller private investors to invest in this asset class. So the investor mix is changing. On the GB side, we also see an uncertainty, which is translating currently into longer exit processes. We observe a mismatch between the prices for companies that are being offered at the moment and then the acquisition prices. But yeah, interestingly, our portfolio on the lower mid-market side has remained extremely stable also in terms of valuations. I think compared to so Q3 2021, our portfolio has still seen a 5% increase in overall valuations. which is mainly due to, I think, some sectors being overperforming, especially those that underlie certain megatrends like healthcare, ICT, and of course also impact and climate solutions, and then other sectors performing more poorly, everything related to industrials, consumer that has been impacted by inflation, energy prices, rising interest rates. But yeah, overall, I think still a good performance of the lower mid-market segment and alternative asset class, especially when you compare this to the stock markets and listed environment.
Thank you so much, Sarah, for this very comprehensive presentation. Time literally flies on this stage. So you guys have like less than 10 minutes each to actually dive into VC activity. And yeah, I know it's kind of, like Survivor type of activity here on stage. And then we'll dive into private markets. Again, if you want to know more and dive actually into every single sector, you can book slots with our experts and the EIF experts at lunch break.
So I will try to make sure that Richard has also quite some time to present the private credit team. So as I said, I wanted you to have a peek as to who we are in the VC team and how we are organized. So I'm very happy to introduce to you our different head of units. So this is really the structure of our team. Contrary to LMM, we are actually organized by sectors rather than by stage. And all of us are actually agile from the very early stages of tech transfer all the way up to very late stage investment across the different teams. So we are a team of 36 investment professionals. A few of them are here. Actually, Adelaide from our climate, leading our climate team is here, and Ghislain also from our digital economy team. I don't know where he is, but you'll be able to meet him during the day. Obviously, we couldn't bring everybody, but we are at least we are a few more so you can have a chat with us. So this is our team. We have currently 750 funds under management, growing by the day, probably going to reach around 800 by the end of the year. This is across Europe, across stages, across sector, spanning out and since the year 2000, and spread across around 315 active managers. This is our VC activity. We show you the last decade because before 2012, unfortunately, we didn't have that much to show. But as you can see, the VC activity has really picked up over the last decade, and the last few years have really shown a major increase in activity. We show you a snapshot of what we did in 2021. 2022 is going to be a little bit of the same, with the exception that climate and infrastructure are going to be much more represented, because as you've heard already quite a lot, this is now a major area of focus for us. So last year we invested almost 2.4 billion in the market. This year is going to be about the same, and next year something quite similar. I'm not going to dive into the different funds that I show here, but I really wanted to show you that we go everywhere in Europe, and we go across different stages. So we really try to deploy a diversified strategy when it comes to geographies, when it comes to stages, when it comes to strategy, to sector focus, actually. Also within each of the sub-teams, so when it's disruptive tech, we will look at AI-focused fund, but we will also look at space tech. When it's in social impact, we will look at very generalist type of impact funds, but we also do quite a number of tech for good funds, for example. So we really try to find the best partners in each of the sectors and in each of our strategies. When it comes to first-time team and emerging managers, as you can see in the VC area, so these are the 2021 numbers. Emerging teams and first-time teams represented 2/3 of the managers that we supported. And this year, 2022, is not going to be any different. 2023, we keep moving. This is what we do. We try to support new teams and on new markets. And we are very lucky that we indeed have the possibility to support first-time team and to give them a financial push when we invest in them. So you can see first-time teams, we represented on average almost 40% of the total fund size. We also, in quite a few cases, went to 75% of the total commitments because we know that in certain markets, if we don't give that push, the funds, they just don't raise, and then it's a lost occasion. So to give you one example, this year we supported our first ever Polish social impact fund, and we are representing 75% of the commitments. As you can see also, it's a navigation. So when you reach the blue slide and you become a blue chip, obviously we represent a lot less. It's also a function of the fund sizes. For sure, the more established manager raise much larger fund sizes, but we also decrease our commitment because this is less and less our role to play. We are really more providing more additionality with the first-time team and the emerging managers. What about diversity? So this is really the object, and this is why we are all here. In our team, I'm very happy to say that we are close to being at parity. Of the last 12 recruitments that we did over the past 18 months, 8 were women. So we are really trying to catch up and walk the talk, basically. It's not only, so it's definitely at every level of seniority. It's also true that our campaigns lately have been really dominated by men. So this is a call also for any woman interested in the fund-of-fund business. We have regular campaign open. If you have any questions, don't hesitate to reach out to any of us. It's also cascading down to our portfolio funds. So this year we made an analysis of all of our funds since 2018, and we actually benchmarked against the InvestEU criteria, gender criteria. You see the conclusion. It's not. It's a starting point. So this is the situation. 12% of women partner in our funds. But we are really hopeful because we also see that the second layer is 30%, and the second layer is definitely the partners of tomorrow. So we see as a starting point, it's a little bit bleak, but we are very hopeful for the future. And what's next, indeed? So thanks to the Commission, we are now we have a very powerful mandate that allows us to give also an extra push to gender diverse team. InvestEU is capped at 25% of commitment, so the tickets we can deploy are capped at 25% of commitment. But if you are a gender diverse team, we can go up to 50%. So there is this is a very powerful tool for us to support gender diverse team. But we're not going to stop there. So you heard it, there are discussions about mandates. How about we also look at the underlying portfolio companies and try to promote more female entrepreneurship and more support to female entrepreneurship? How about we start to have a diversity clause in our side letter, whereby fund managers actually commit to make all efforts possible to actually recruit more diverse. So I think today is really a starting point, and it's good that we can measure and we can show the starting point, but I'm really looking forward to the next 5 years and to be able to stand here in 5 years from now and show numbers which I'm sure are gonna improve. And with this, I will pass the word to Richard.
Good, thank you, Elodie. Now just diving into the private credit business. Just to give you a brief overview, so we are a team of 7 professionals led by Francesco Batazzi, who is sitting there. We don't have a picture like the others, but I'm sorry about that.
But you have person in real life, right?
Exactly. We are a team of, with a mix of female and male professionals. So we are also striving to, let's say, increase our diversity in our team. So going back to the slide, as mentioned by me previously in the intro section, we look at closed-ended commingled funds with a typical LPGP structure. On the left-hand side, so when you see the LPs, we try to take a corner store commitment and attract additional potentially institutional investors, also high net worth individuals or MPIs. And in order to ensure alignment of interest, we expect the team to provide a certain level of commitment, typically expressed as a percentage of the total fund size. So what are the different strategies that we support? Basically, if you look at the capital structure of a company, then we have a bias towards the senior space. So strategies can vary from pure senior debt to senior stretched to unitranche, which combines senior debt and subordinated debt into one loan, and then asset-based finance, whereby the purpose of the financing is to, for example, purchase key machinery for an SME, or other examples could be maritime funds. What we don't do is that we don't back basically distressed strategies for several reasons. But I guess the others give you quite a good overview what we do. These strategies are basically buy and hold strategies. So these are self-liquidating instruments. With the banks being more reluctant to provide financing to SMEs and small mid-caps, private credit funds stepped into this space and filling the financing gap by providing bespoke, flexible, and in most cases, long-term financing. How can it be bespoke? For example, they can offer a portion of bullet repayments, or the maturities can be longer compared to traditional bank financing, or there could be different, let's say, grace periods, etc. What the key characteristic of these funds are is that they provide a periodic fund income, so we see cash distributions, and sometimes if the underlying is amortized, then we see also repayments. But in many cases, we see that repayments are, let's say, reinvested during the investment period in order to ensure that we have a sufficiently diverse underlying portfolio. When it comes to target returns, they basically span from low single digits to higher single digits. Now that some of our funds, I mean, a large chunk of our funds are offering floating rate instruments, so we may end up seeing even double-digit returns now that the interest rates are increasing. And if we look at the, let's say, the credit risk, typically these funds fall into the double B, single B categories. So we mentioned what our sweet spot is. Yes, it's the lower mid-market. What does it mean in terms of numbers? If you look at the EBITDA of our underlying investee companies, it goes up to 20 million euros. That's our sweet spot. If you look at the big private credit space, there are two categories: sponsored, representing roughly 80%, and non-sponsored. We really like the non-sponsored space because many SMEs and lower mid-market companies can be found there who lack financing. The difference is that this space is a bit more specialized. It needs a more unique skill set compared to the traditional sponsor space, which was driven on the back of the successful fundraising period of the previous years for private equity funds. They were sitting on a large dry powder, and they needed basically private debt funds to complete their transactions. Whereas in the sponsorless space, you need to have a unique origination network. You cannot rely entirely on financial intermediaries. You need to have a sort of a niche strategy, and the collaboration resembles more of a partnership approach. It's more like a slightly private equity type of approach, where you have more influence on the underlying assets. But actually, the sponsorless space offers slightly higher returns if you do it right, and you will have a better downside protection because you will know more about your underlying investee companies. And then the third theme of our sweet spot is that we see the emergence of ESG and impact-focused funds. So, of course, this plays a key role in our investment selection. With the introduction of the EU SFDR in March 2021, we started to see the emergence of Article 8 and Article 9 funds. The Article 8 ones are the ones that promote certain ESG characteristics, whereas the Article 9 ones which have a bespoke sustainability investment focus. If we look at our, let's say, pipeline, for this year, we see that 45.5% are Article 9, 45.5% Article 8, and then less than 10% Article 6. Typically, Article 6, they are from, let's say, regions which are more underdeveloped, where we would like to play a key role, even though they don't comply with any of the ESG or impact requirements. And then if we look at the teams, they basically tackle three main areas. They provide either impact debt, or they try to mitigate the climate change, mainly providing decarbonization strategies. And the third one is focused on improving energy efficiency. Just a few words on our track record. So we have analyzed in excess of 380 GPs since our existence from more than 20 countries, so basically all around Europe. If you look at the deals that advance to due diligence stage, they represent roughly 20% of our deal flow. And then with the churn of another 5%, 50% will lead to actually signatures. If you look at the breakdown by applicants stage, then 50% they are coming from the developed markets. So originally it was UK. Now that following the Brexit, it was more like France, and then also Germany. And then we have also a big chunk from emerging markets, and then less than 10% from underdeveloped, which are mainly coming from CEE. So this is where we play more of a policy role. Investment experience. So if we exclude mezzanine, so we just really focus on the senior space, we deployed 2.8 billion in more than 60 funds, representing more than 3,000 underlying investee companies. If you look at our annualized loss provision rate is 0.35%, which I think shows the rigorousness of our investment selection process. And if you look at the gross return, it's close to 7%. We have a healthy mix of established, emerging, and new teams. And senior financing and unit tranche, they represent the biggest chunk. In the interest of time, I'm speeding up a bit. So what are the market trends? What you need to know is that private credit was non-existent in Europe before 2012. So the COVID was the first test. It performed very well. And now this is the second test post-COVID. We haven't seen any correction in our funds, but we expect to see potential defaults or issues H1 next year. As mentioned already, sustainability-focused funds are key. And as Sarah also mentioned, that the fundraising environment is becoming more and more challenging, especially for first-time teams from underdeveloped markets. But this is where EIF steps in to provide some guidance. And there is more complexity, and the deployment is also slower because private equity funds also struggle with fundraising, which has an impact on the dry powder, and this has an indirect impact on the private credit space. Just a few words on our on diversity, confirming that there is a long way to go here as well. If you look at the applications this year, we see that actually 1 in 4 private debt GPs meet one of the InvestEU gender criteria. And yes, we try to see and seek for new teams that are sufficiently gender diverse. This is confirmed by the study that was launched by EIF in 2021 with roughly 150 respondents. Basically, proportion of female employees is below 25%, more or less in line with what you see in the world. And if we focus on only Europe, then senior professionals represent slightly more than 10%. Female senior professionals, and roughly 20% of the decision-making bodies are female majority-oriented. And then at portfolio company level, it's even worse than compared to private equity, but it's fair to say that private credit players have, let's say, smaller influence on their companies, but in most of the metrics, they are below 10%. Thank you for your attention.
Thank you so much to the three of you. So, of course, you can ask them anything, but we have time for one single question. I'm so sorry about that. But I mean, you'll have plenty of time to, like get into and dive into more questions with the three incredible experts at Coffee Break, which is just upcoming. So do we have one question? Oh, we do. Wonderful. So we'll take the question from the floor. Just stand up if you can so we can see you. Thank you so much, ma'am.
I hope you don't mind. I have a venture question, so it's quite directed to Elodie. You showed us the slide where you showed emerging managers and first-time managers, and I'm sure some of the women in the room have tried to get into EIF before as fund managers. The feedback was always emerging managers or first-time managers are not for the first time in VC. Can you elaborate a little bit about the criteria? Have they changed now that InvestEU is or gender smart targets have been set? Are there other criteria of what a first-time manager is and what an emerging manager team looks like? Thank you.
Thank you. So I'm going to try not to steal Patrick's thunder because I know he's going to touch on these topics afterwards, and I hope I'll be consistent with what he says. But so first-time team, very transparently, we are an institutional investor. So backing a first-time team that has limited to no prior investment experience and no prior joint experience in any sort of form. I mean, it doesn't have that you were working together in a fund before that. But as an institutional, those are the hardest ones that for us to push through because it's very difficult to make the assessment as a team level. So first-time teams that we back typically have either raised a small fund or did a few angel investments and partnered in a way or another with the partners that they bring together in the teams. Emerging teams, we count from Fund 2 to 3, and those remain in the emerging section. It remains emerging until you can demonstrate and prove your strategy, until you can really show a few exits. Obviously, there are many ways to prove your strategy, but exit remains the overarching test. So things have moved a little bit, but first-time teams with really no prior joint working experience and no prior investment experience, these we really typically don't do.
And we definitely dive in more in a few seconds for now into the process, which you definitely need to learn a little more about to actually get funded, of course. Okay, let me take just one more question. There you go with you, ma'am.
So in terms of gender equality, I know it's great that you're backing women as fund managers, but how do you assess what they invest in? Is there a equality mandate there?
So the answer is no. There's no gender equality mandate yet, but who knows what the future holds. For sure, we see more and more strategies that are actually gender diverse teams that also want to cascade down the strategy to their portfolio companies. So we see that more and more, and definitely this feeds into our investment analysis. We see this as a positive point, but currently there is no mandate available for this type of strategies. Neither, I think, none for VC, but neither for LMM or private debt at the moment.
Okay, thank you.
Maybe just to add one small point, we are paying more and more attention to how GPs and teams assess ESG within their proposals. We also expect a reporting from them on various elements, and diversity and female representation at the level of their portfolio companies is becoming a more prevalent measure also, and an element that is being reported on annually. So it has not yet become a specific requirement, but we start having a better visibility on how the management teams of the underlying portfolios are structured.
Thank you so much for your question. Thank you so much, Elodie, Sarah, and Richard, of course, for your perspective and answers.